riding shotgun with Richard. I'd like to talk about mortgage insurance this morning and what that entails. So, mortgage insurance, let's talk conventional loans. It's actually called PMI. People are familiar with that term, which stands for private mortgage insurance. It's a third party company that's insuring the loan. Now, as a buyer and homeowner, do you benefit from PMI? Because many people have kind of a negative connotation to that, they hate PMI. But what you have to remember is um, you're benefiting because you're not required to put a larger down payment to purchase a home. So the PMI company is stepping in and insuring up to a certain percentage your mortgage, so the lender will allow a smaller down payment. So if that loan was to default, which obviously the collateral for the loan is the house, and so when they have to take a home back in foreclosure, there's a lot of losses there, significant losses. So mortgage insurance helps cover the lender to recoup or have a little less loss on a foreclosure. So as a home buyer, you absolutely are benefiting by not having to come in with 20 or more % down for your purchase. So there is a benefit there to you. Now, nobody wants to pay it longer than they have to, right? So there are provisions that it does fall off on a conventional loan naturally per the amortization schedule once you reach a certain loan to value, but there's also other ways to have it removed. If you paid down your mortgage, made extra payments to your principal, which I encourage you to do for other reasons, but we can talk about that one later. The other way is obviously the home appreciation value. As you pay down your mortgage and over time homes do appreciate, they become more value, sales value based on the market. So you could reach it much faster than your amortization schedule. You just have to reach out to your lender who's servicing your loan and ask them to evaluate it. They might require an appraisal. There's a good chance they will. But it could be very worth it depending on what you're paying in mortgage insurance. There's things like when you first buy your house, you can do a single premium with that type of mortgage insurance. It really depends on how much you put down and what your credit score is on if that's cost effective or not. So we analyze that and say, okay, how much does it cost just to buy it out, and what's the monthly payment with it? Does it make sense? The good thing about mortgage insurance, it's less expensive than it used to be depending on your credit score. Higher the credit score and the more down payment, the lower the mortgage insurance cost is, because the coverage ratio doesn't have to be as high. So if you're putting 3 or 5% down, you're going to pay higher mortgage insurance than if you pay 15% down. So we just have to look at that and see what works for each individual buyer. Now, there are insurances on all types of loans. Like, for example, they call it something different though. FHA loans, they call it an MIP, mortgage insurance premium, instead of private mortgage insurance. That's FHA insuring the loan. A little different with them. They require the life of the loan, unless you make 10% down, then it would fall off in roughly, don't quote me, but 11 years, I think. Let's see here. What else on FHA? The thing about FHA, really, we have to analyze what loan product fits the borrower's financial picture the best. Sometimes FHA is better than conventional for certain borrowers, depending on their credit score, because the mortgage insurance premium can be pretty high if you have a lower credit score on conventional, and FHA is the set. Doesn't matter your credit score, your mortgage insurance is 0.55%. So, and typically, depending on score, FHA rates can be lower than conventional. So when you blend those two together, it could be more cost effective to go FHA initially, and maybe down the road refinance into conventional once you got good loan to value and maybe your credit score is improved enough for that to make sense. USDA, very similar. They have the same thing as FHA, but it's a lower premium, and it is life alone as well. Period. There's no removing that one. At VA, they have what's called a funding fee. They're guaranteeing that veteran loan at 100% financing. So that's what the funding fee is for, that's financed in the loan on VA. But of course, if you're a disabled vet, then you don't have to pay that either. So you don't have to have mortgage insurance. They're guaranteeing it for free. What else? What else on mortgage insurance? Oh goodness. I think that's about it for today. So it's not a bad thing. It's just something that you gotta take advantage of to put less money down, and or depending on the loan product. If you're curious about any of that, just reach out. Happy to discuss it anytime. And once again, it really boils down to each individual's financial profile on what loan works best for them for their given situation. Sometimes they just would rather have less out of pocket, so they would take on that mortgage insurance, and or they, it might be really payment sensitive, so we need to focus on can we buy it out, can we go FHA, is it a better payment, that kind of thing. So have a great day, everybody, and we'll talk soon. Take care.